My oh my, what a tough day we had on Wall Street. Most market indices were down over 2% here today. In fact, this was only the sixth 2% plus down day that we've had for the S&P 500 over the past year. The Dow Jones managed to not quite close lower by 2%. I think it was 1.87%, so it was our leading index today. But even for it, it was its worst day for the Dow in calendar year 2022. There just simply weren't a whole lot of places to hide out here today. A couple of the places that did manage to kind of kick into the green status were gold. So we're going to talk about gold's trend in tonight's video. We're also going to talk about the consumer staples, especially the dividend aristocrat consumer staples, some of them raising their dividends here today. They managed to close in the green alongside some utilities and other areas. We'll talk about the various industries as opposed to sectors that managed to kind of withstand today's storm as well. Then we're going to get into our trade application example, where I wanted to focus on a sold put candidate that would be considered a secular growth stock, one that has appeared in the Investors Business Daily Large Cap 20 many times over the last few years and is down substantially from its highs to a point where we now have oversold clusters on a weekly candle chart. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 17th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. And you'll also be given a heads up as to which stocks are giving you overbought and oversold cluster signals within the S&P 500. So on a big sell-off day like today, I imagine there's going to be a couple dozen oversold clusters within the S&P 500 today. Also, we're heavy users of Twitter. My handle is @BrandonVanZ. I'd encourage you to follow me if you're not doing so already. And we really appreciate those of you that click like and retweet on these Market Outlook related tweets on Twitter. And then last but not least, we have a Facebook presence. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. Let's play a little bit of red light, green light, and you can see today it was mostly red. Here is the heat map for the S&P 500, and you had to be pretty lucky to avoid the bloodbath that was today. Fortunately for those of you that are dividend growth investors, you had a slightly better opportunity to withstand some of the pain. As you can see, a lot of our green boxes that are showing up on the charts are more traditional dividend stocks. In fact, specifically, the dividend aristocrats had a fairly good showing today. Walmart is a dividend aristocrat. It was up 4% today. Coca-Cola is an aristocrat. It was up 2% today. Both of those, by the way, announced dividend increases today. Coca-Cola announced their 60th increase in a row. So 60 years in a row of dividend increases. Some of you might have caught that on my Twitter feed earlier today. Pepsi was also up today. It's a dividend aristocrat. Just barely up, but up nonetheless. Procter & Gamble is a dividend aristocrat, up 1.15%. Colgate is a dividend aristocrat, up 1.03%. Kimberly-Clark is a dividend aristocrat, up 0.47%. Church & Dwight is our newest dividend aristocrat that was just added to the list here in late January. It was up 0.96%. And then good old Clorox. This is a stock, of course, near and dear to our heart as we have an open trade on that one, as we did a bullish sold put example on it about a week ago. It was actually one of the better performers in the market today, up about 3% there. So really good showing out of your kind of traditional dividend aristocrat companies there. You also had a fairly decent showing from just a handful of the oil stocks. So you can see like Conoco and Pioneer, Devon, they were all up nicely today. Then you also had a smattering of the utilities that were up here today. Remember, they're not all that big of market caps, so they don't have a lot of influence on the market, but it does give you a sense that there was more of a defensive tilt towards the market today. You can also see over here, Cisco was one of our winners today off of their earnings announcement. They actually increased their dividend last night. It was a little bit underwhelming there, only 3%, but nonetheless, still good to see them being more generous with their shareholder policy than they were previously. So other than that, it's been tough, right? Look at all that red out there. Microsoft, of course, the bearish trade I just showed you guys and did for you on Tuesday was down about 3% here today. Some of you know that my trade application example in tonight's video is going to be a sold put on a company that's really been blasted here recently. We'll get to that in due time, but I just wanted to kind of point out, I hope you guys kind of get the general sense as to how I'm going about my trading during these presentations here more recently, where more times than not when the market is up like it was on Tuesday, I'm looking at that as an opportunity to put on bearish trades. And when the market is down significantly like it is today, I look at that as an opportunity to sell puts, which is a bullish trade, but it's a very conservative bullish trade where it gives you plenty of flexibility to be wrong. So I'm not being aggressively bullish on days when the market is selling off in this environment. I still think we are in the market environment where we are better served selling the rips and being a little bit more cautious around the concept of buying the dips. Are there opportunities that emerge out there? Of course, but in general, you want to try to play the odds to your favor. So, hopefully some of you have been kind of catching that mindset that I've been having with you here more recently. Also, a lot of times we kind of talk about things from kind of a sector perspective. And you'll notice, by the way, Tesla was down quite a bit here today, as Kathy Wood, I understand, was on CNBC earlier today. Of course, that's one of her big holdings there, and that one has really struggled. You did see a couple of these defense contracting companies like Lockheed Martin and Northrop Grumman up here today. Of course, that has a direct tie-in to what's going on with Russia and Ukraine. But I wanted to quickly show you here, before we get going too fast, I did just post this on Twitter here not too long ago. A lot of times you'll hear us talk about sectors, and that can kind of give us an idea as to whether we have a risk on or a risk off type of a mindset during the markets. Remember, you could also take that a step further and look at industries in addition to sectors. I thought this was kind of interesting today because, as I say here in the tweet, it's a decidedly defensive tilt towards today's trading from an industry perspective. And as you can see, there were a number of industries that were green here today. Remember, there's only about 68 or 69 industries, so the fact that we had at least this many in the green is worth mentioning. But what caught my eye is not necessarily that, and there were more than this, so this is just the top 9. So that goes to show you it wasn't a complete bloodbath out there today. There were actually industries that were up, but what caught my eye here is how defensive this is. If you were to look through these, I know it might be hard for you to see if you're watching this on a cell phone right now, but I'll read them off here, and you'll definitely know when I'm reading them off whether these are considered growth industries or defensive industries. Food and staples retailing, Walmart. Water utilities, American Water Works. Household products, Clorox. Communications equipment, that's the only one out of this batch that could probably be considered not quite as defensive, but that one got boosted here today because of Cisco. Beverages, Coca-Cola. Tobacco, Philip Morris. Gas utilities, so think about like Sempra Energy and Northwest Natural and some of those types of companies. Food products, think about General Mills, and then multi-utilities. That is about as defensive of a leadership group from an industry perspective as you could possibly put together right there. Again, the only exception to that is communications equipment, because they got the nice blessing of having Cisco on their side on the day when they reported a nice earnings announcement. All the rest are where you go to hunker down when you are concerned about risk taking. So without a doubt, it was one of those risk-off types of mindsets that we saw here today. Let's pop on over to the Thinkorswim platform, and I wanted to show you from a breadth perspective. I'm now on the Market Watch Visualize tab. I've got the S&P 500 pulled up here, and you can see that we had 73 stocks that did close higher here today within the S&P 500, whereas we had about 429 that were lower. So we only had about 15% of the participants closing in the green today, and most of them are in those kind of more defensive consumer staples and utilities types of areas. those dividend growth types of companies. Pretty much if you had anything associated with growth out there, you probably got hit pretty hard here today. So it was definitely a tough one. In fact, let's go ahead and take a look at our charts now, because I always like to point out this chart 6D on a big either up or down day. Today, of course, is a big down day, and it's a rare day where we actually breach that orange horizontal line down below. Now, remember how you read this is there is a zero line that kind of goes through the middle there that would basically represent a flat day. The higher the green bars grow to the top means the more aggressive the price returns were for the S&P 500 on that day, and the more aggressive the red bars go towards the bottom is the more aggressive selling days. So of course today was one of those more aggressive selling days, and this is actually only the 6th day in the last year where we finished the day down more than 2%. We had one of those days back here on February 25th of last year. We had another one of those days here on May 12th. We had another one of those days on September 28th. We had another one of those days here on November 26th. And then we had a fairly big sell-off day there on February 3rd of this year before today. So this is only the 6th time in the last year. And remember, there's probably, 250 trading days or thereabouts in the last year. So to have only 6 days representing 2% pullbacks is it's a fairly rare event. Today was one of those days. So it was aggressive out there. You'll also notice, of course, that the VIX did rise today. Remember, that is fairly typical. When the market is down, the VIX goes up, all else being equal, as there's more fear in the system and people are trying to hedge their portfolios by buying puts and doing all that kind of stuff to drive the VIX higher. So we did end on the VIX at 28 here today, which is up quite a bit from where we were just a couple of days ago when I was last with you. At that time, it was at 25. So are we back to the highest levels of the VIX when it was above 30 here at the end of January? Not quite, but then again, our price isn't quite back to those levels either, right? The S&P 500 as it stands right now at 4380 is not quite to those lowest levels of around 4250 or whatever it was there in those uglier last trading sessions of January. At this point, I wouldn't be surprised if we get there, right? I've been pretty upfront with you regarding what my opinion is of this market. If you've been listening to my presentations, I had to kind of stick my neck out on the line here, a week ago or whenever it was when we had bullish postures on the market forecast technical indicator, but I said I wasn't trusting it. I still think that we are in a market environment where the path of least resistance is to the downside, and we can see here a week or so later that those bullish postures have now given way back to the bearish side of the coin. So until we start spending significant time above these moving averages, I don't trust this market. Now, is there opportunities there? Of course. We try to do our best to look for those opportunities every single week. In my Tuesday dividend growth investing class is just one example to look for those longer term opportunities. But if you're a trader, you're probably better served on the bearish side of the equation as opposed to the bullish side of the equation. So similar to what I did with the Microsoft bearish trade for you on Tuesday, and with the Danaher bearish trade that I did for you the prior week, etc. You're finding better success on that bearish side of the coin, and if you're constantly doing bullish trades, you're probably getting run over right now, and it still doesn't look healthy, right? And so I would say caution is advised. You don't need me to tell you that probably, but it continues to be the case. This is not a good-looking market. It's not healthy. Now, one of the interesting things I shared on Twitter yesterday came from the Stock Traders Almanac, where they go back and they look at all of the statistics of trading over the years, and they kind of break it down into political cycles as well. And the midterm year, the one that we're in right now, traditionally is not a very strong year for the market anyway. A lot of times you get flattish performance at best. And remember, that's considered an underwhelming year for a market that tends to go up 8 to 10% over the long haul on an annualized basis. So right out of the gate, know that this is a more difficult year traditionally. But in addition to that, what I was tweeting about is that usually the markets in the midterm years do find some sort of a bottom in the month of February. So we've got another couple weeks to see if that's going to happen or not. And then typically you do have a rise into April. And then we give way again to the sellers, and into the summer it starts to get a little bit rockier once again, where oftentimes those previous lows are breached once again. So in other words, prepare yourself. We could have a rockier year in front of us here in 2022. Compared to the very nice year we had in 2021, where the biggest pullback we experienced the entire year was only 5%. And even 2020, if you were to, withstand the storm of the coronavirus meltdown early in the year, you actually had outstanding returns by the end of 2020. So I think a lot of newer traders and investors to the marketplace may be surprised whenever we get that first calendar year where you're actually down. And remember that it should not be considered some sort of abnormal experience. Throughout history, the markets tend to go up about 2 out of 3 years, which means 1 out of the 3 years you have flat to down markets. So if you are newer, hang in there. These are not fun times, but they're the best times to learn at the same time, right? When I first started trading back in the dot-com bubble, over 20 years ago, stocks like JDS Uniphase were all the rage, and Pets.com and all that kind of stuff. And I learned a lot of lessons back then. And that was back when I was in my 20s. And if you find yourself watching this YouTube video right now and you're in your 20s and you're feeling discouraged by what's been happening to growth stocks or whatever stocks you're interested in here more recently, hang in there. At least you're making the mistakes while you're young, and you whether you know it or not, you probably have lower amounts of money right now as a 20-year-old than you will when you're 60. So it's better to make your mistakes when you are young than when you are older, when there's more consequences that come with those mistakes. So I know it's not probably the message you want to hear, but take it from somebody who's been there. Things will get better, and you'll work on your own skills, and you'll improve as time goes on. And, this is all a journey, right? And that's life in general. We try to get better every single day. And if you need assistance with that, of course, one day we'd love to have you become part of our premium program at Market Scholars as well, where we talk through all of these things. And, we use class rules and as opposed to just winging it. And we try our best to outperform markets in, multiple environments as opposed to only doing well in a certain type of a market environment. So anyway, just hang in there, I guess is my encouragement to you. As we look at these 4 indices here, you'll notice that the S&P 500 was down 2.12% today, and you can see we're kicking down and away from those falling 30-day moving averages again. We are now in this darker shade of pink here, telling us that we have a strongly bearish posture. Remember, we had that one day right there briefly. Actually, it was exactly a week ago because it was my birthday. I said I wanted my birthday wish to be a Rams Super Bowl victory, and they came through for me. But it was on that day we actually had a bullish posture on SPX, and it was that day I said I don't trust that at all. In fact, if anything, this looks like a perfect time to be doing bearish trades because we're rolling back and away from that falling 30-day moving average. And here we are a week later. Obviously, we have fallen substantially over that time. So usually I'd like to use the posture and the moving averages in unison. On that day, it was telling us that the posture was one thing, but the moving average was still moving lower. So until those two things are hooked up together, I'm going to be a little bit more hesitant around just assuming that the posture mechanism is going to work. If we start stabilizing and finding some lows here, and then we start spending some time above the moving average, then the posture changes to bullish, then you got my ear. But until then, I'm just going to be more hesitant in this type of a market, and it still doesn't look good. In fact, I'd say there's a pretty decent chance at this point that we start breaching some of these lows that felt really awful at the end of January. I think it's probably in the cards right now that's the path of least resistance. That's where we're heading. Remember, tomorrow is options expiration day for the February contracts, and so we may have some crazy price movement there, the way that we did back in the January expiration day as well. But in addition to that, remember, the markets aren't open here in the United States on Monday. It's President's Day holiday here. And so you got to ask yourself, how many people are going to be willing to hold their positions into the weekend when you know that Russia, Ukraine could just blow up at any moment in time, right? A lot of people feel like that situation could get worse before it gets better, and it's more likely to happen after the Winter Olympics come to an end, which, if I'm not mistaken, is this upcoming weekend as well. So, it's a little bit more of a precarious weekend to be holding stocks into for a lot of folks. Now, if you're a long-term investor, that should not affect you. If you're a short-term trader, then you got to start thinking about things like that. And so, in other words, we could very well end up having a pretty ugly day tomorrow as well. Hold on tightly. It's gonna be a rocky ride here. So we remain with a strongly bearish posture, no surprise, on the S&P 500, which is currently trading below its falling 30-day moving average, and we had our sixth 2% meltdown type of a day here in the last year. The Dow actually had its worst day of calendar year 2022. We couldn't get away with saying that on the S&P 500 because you had a couple of other days that might have been slightly worse, like this candle here on the 11th was really bad for the S&P 500. But for the Dow, this is actually the worst performance so far this calendar year, not the full rolling last year period, but this year, 2022. This was the worst day for the Dow. It was down 1.78%. Remember that the Dow had been our relative leader. It continues to be. Even today, when it had its worst day of the year, it still did better than the other indices, right? It was the only one of these four that managed not to be down at least 2%. It was down 1.78%. But same thing. This chart does not look good, right? Even if you are hunkering down in the blue chips, you're still finding struggles there. Today was a good day for those aristocrat staples, as I mentioned to you before. But, the other types of stocks that are in the Dow, like Apple, as an example, are not acting as a safe haven right now. So even the Dow chart does not look promising here. This looks like this chart needs to go lower before it goes higher. We are now back to a strongly bearish posture on the Dow Jones Industrial Average, in addition to having it falling below that falling 30-day moving average there. So that's somewhat new, right? Yesterday, I'm sure David alerted you to that as well. Didn't get a chance to watch his video, but I'm sure he mentioned to you that we went to a strongly bearish posture on the Dow yesterday, and we continued that today. And that is somewhat new because remember, the Dow, since getting out of that strongly bearish posture back here on January 27th, had been that relative leader since then. So while we had a couple of days here and there with bearish postures, they were weekly bearish postures. That is all in the rearview mirror now. We are back to strongly bearish postures on the Dow. You can see here that the intermediate line is at 40 and falling. So remember, when that's below 50 and falling, we consider that strongly bearish. Notice that the NASDAQ composite was down 2.88% today. Another aggressive sell-off day for that growth-oriented index. Nearly a 3% bleed off there for the NASDAQ. Same thing. The chart looks terrible, right? I hate being the bearer of bad news. I hope you guys all know that, my own portfolio suffers on days like this. So when I bring this news to you, I'm not trying to be cheery because I'm somehow benefiting from this. It's not the case at all. Trying to present the facts as I see them, and these charts look terrible. The NASDAQ is rolling over under its falling 30-day moving average, and it continues to have these strongly bearish postures here, that dark pink background, just like we saw up there with the S&P 500, the somewhat newer one there with the Dow Jones, and the NASDAQ has had this strongly bearish posture for the past week or so. Russell 2000 was down 2.46% today, so not quite as much as we saw with the NASDAQ, but right there in that general vicinity. The Russell 2000 had actually been outperforming in recent weeks compared to the NASDAQ. Notice how the NASDAQ, you've been really carving out lower highs and lower lows since, let's call it February 2nd. We look at February 2nd here on the Russell 2000, and you could probably get away with saying we have slightly higher highs and higher lows there. So we don't want to discount that too much, but the reality is there has been a little bit of a baton shift there where the Russell 2000 has been acting better than the NASDAQ over this past, let's call it 2 to 3 week window. But that didn't save it today. You see that after barely closing above the moving average yesterday, you gave that all back and then some here today. So notice that the moving average color changed from yellow to red here today, signifying prices back below a falling moving average. And you have that strongly bearish posture from an intermediate perspective there as well. So, to summarize, it's awful out there. These charts look terrible. They've got work to do. There's broken support levels all over the place. We still have relatively high valuations, if you can believe it, in many cases. And there's a lot of people that are interested in selling first and asking questions later as a result of what's going on with Ukraine, Russia, and as a result of what's going on with input costs and inflation and the potential for the Fed to be hiking rates here very quickly in the next couple of months. So there's a lot of challenges that we're dealing with in the market right now, and that is shining through in these ugly charts that we're witnessing before our eyes. Let's take a look here at our 3 green arrow status, although I would imagine that today we'll have a lot of 3 red arrows. Let's see if I'm right. Actually, not quite as right as I thought I would be. I figured we probably have at least 3 out of the 4 with 3 red arrows. In this case, we actually only have 2 out of the 4 that have a 3 red arrow signal right now. Those 2 are the 2 up at top. The S&P 500 has a 3 red arrow signal, and the Dow Jones Industrial Average has a 3 red arrow signal. Down here on the NASDAQ Composite, we're still barely hanging on to the green arrow on the MACD histogram, but that could go away as soon as tomorrow because of how close it is to the zero line, right? So if we have a big sell-off day into the weekend, pretty decent chance that the NASDAQ Composite goes to 3 red arrows tomorrow. Russell 2000, I don't think it's going to happen. Not to say that it can't sell off tomorrow, but it's just to say that the sell-off would have to be extremely aggressive to push the current MACD histogram, which is this gray bar I'm kind of circling here in the lower right-hand corner. For it to go down below that zero line would have to be a massive push. So I'm not anticipating that on the Russell 2000. Could happen as early as, next Tuesday or Wednesday if we have multiple days off in a row. Again, we're not trading on Monday, but I do not anticipate Russell 2000 going to 3 red arrows tomorrow. I do think there's a decent chance of the NASDAQ Composite doing that if we have a sell-off into the close on options expiration day before we go into a weekend where there's a potential war that could erupt at any given moment in time. So be on the lookouts for that possibility. But obviously not great looking charts here, and the technical indicators are showing us that there's more bearishness than bullishness across the board here. Let's go ahead and pop on over to the internet. I always like to say thank you to those of you that help support these presentations. And wouldn't you know, you guys got to exactly 100 likes the last time I did the video on Tuesday. So thank you to those of you 100 that contributed to that. You know that nice round number is meaningful to me because if we're up and over 100 likes, or in this case exactly on 100 likes, then I give you a full-length video, which includes a trade application example, like the one that I did for you on Tuesday, where I did a bearish trade on Microsoft, which is doing really well right now. So I have to assume you guys like trades that are successful trades and you want to see more of those. And if that's the case, then I encourage you, as I always do, to click like there on Twitter, because had this been 99 instead of 100, I would not be presenting a trade application example to you at the end of tonight's video. Now, with that particular trade, maybe that would have been a blessing. We'll never know, right? Sometimes I present a trade idea and it's not going to work out. It would have been better off had I not even mentioned it, but at least you would know what it is that's on my mind in terms of what I'm thinking about trading, and then you guys as individuals can make the determination as to whether you want to consider it for your own portfolios or not. So those of you that clicked like, I really appreciate that. In particular, Ron Pearson, you, I believe, are the 100th liker. So without Ron helping us out here, we would not have this full-length video. It'd actually be done by now because it would have only been 15 minutes. So thank you to Ron and the 99 others that stepped up, whether you know it or not. Each and every one of your likes was meaningful in today's case. So thanks to NZ Toss and Teddy and Tat and Dennis and Tom and Evan and Margie, Serene and Brian and Ken and John and Mary and Dale and Roger, Eddie, Kirk, Paul, Sheila, and everybody else. Too many names to mention, but all of you are rock stars, and I appreciate that. Also, let's take a look over here at, and by the way, maybe it was all of you Bengals fans that didn't want to click like last time around because I was supporting the Rams gear. I'm gonna cool off on that going forward now that the season's officially over, and the Rams will be Super Bowl champions and defending champions when we head into September. But until then, I'll kind of give that a rest a little bit. But thanks for bearing with me as I had a little bit of fun with my favorite team there. On the factor selector here, remember this gets produced on Tuesday night / Wednesday morning. So the data is as of Tuesday night's close, and it usually gets posted to our website Wednesday morning before my swing trading class. So we did have the same outperformer on the upside that we've seen over the last month, which is dividend yield. Of course, something that's near and dear to my heart personally. But like I always like to say, when dividends are outperforming, it's usually a bad thing for the market in general. So I have to learn to kind of temper my enthusiasm a little bit because whether we know it or not, it's usually a risk-off type of a mindset when dividend stocks are outperforming. And that is what we've seen here over the last month or thereabouts. We also saw value retaining its value in the number 2 position there. Remember, value is chocked full of oil and gas companies along with financials like your banks. And so those areas are holding up a bit better than some of the other areas out there. Low size had a big move higher. Now, remember what I just mentioned a moment ago on the 4 grid where the Russell 2000 had shown some outperformance here in the past month versus something like the NASDAQ composite. So I think that's kind of adding to the appeal of low size. Now with today's sell-off, remember that would not have been accounted for in this tool at this point because that would have been Tuesday night there. So there might be a little bit of give back there, by the time I produce the tool again on Tuesday. So keep that in the back of your mind there. But it was an impressive move, so it's worth pointing out there. And since low size left the bottom position last week, something had to replace it, and it was quality. Now, one of the poster children of quality that I always bring up with my students is Microsoft. Right? It's one of only 2 AAA ranked companies in the United States, along with Johnson & Johnson. And so Microsoft, as I mentioned in Tuesday's video where I presented the bearish trade idea to you on Microsoft, has been faltering here lately. So I guess we shouldn't be completely surprised to see quality fall back to number 6. But like I mentioned to my students in my Wednesday class, quality is one of those areas where I would not anticipate it staying at the dead last position for a long period of time. I could be wrong about that, but just judging by what I've seen over the years, quality usually finds its kind of cozy spot in the middle of the rankings and rarely stays at the bottom position for long. So if we have a struggling market in the coming week, I would say there's a decent chance for momentum to fall back to the worst position on the factor selector because those are your go-go momentum names that, easy come, easy go. The stocks that have done the best in recent years, like, Peloton and Zoom Video and DocuSign are also the ones that have gotten absolutely annihilated in the last several months. So those types of stocks could very well find their way back to the bottom portion of the graphic. So we'll all find that out next week when I produce it again. Also, earlier today, we taught our traditional classes here at Market Scholars. I taught my question and answer session for my premium students here today, and then David taught his portfolio management with ETFs class earlier today. So make sure you're checking out the recordings if you have access to those classes as either plus or premium members there, depending upon circumstances. Tomorrow, remember, David will be teaching his quite popular popular technical analysis class at 1 p.m. Eastern Time. So if you've wanted to learn his direct thoughts and insights as a chartered market technician, tomorrow will be a great class for you to sink your teeth into at 1 p.m. Eastern Time. In terms of the class that I taught earlier today, here's a rundown of some of the classes, or some of the questions, I should say, that I was answering. It was another marathon session where we were at it for well over 3 hours once again. So Linda had asked me a question about my thoughts on the debt load of the U.S. government and whether that borrowing will be on the backs of our children and grandchildren. And, some of my thoughts in terms of, will it spell disaster, or do we have some built-in advantages living here in the United States? Also, got a question about looking at ALLE, which is Allegion's business model. Not a company that a lot of people probably are familiar with, but a company that makes locks and security devices and things like that. So got a chance to look at some Morningstar information for that company. Also did kind of a show and tell on how to operate a paper money account when one of the companies you own does a spinoff. So Exelon, which is a utility company, recently spun off CEG. So I showed the students how to accomplish that in their paper money accounts. Also got a question about how to determine which members on our website are premium members. So who are the premium members and who aren't. So there will be little blue check marks there. So answered that question. I got a question about somebody who had listened to a presentation by Invesco recently, and some of my thoughts on if the market cycle moves back towards kind of the quality and secular growth stocks, are there any that are on my radar right now? And that'll actually tie in nicely to our trade application example later on tonight. A lot of times the thoughts that are flowing through my mind are as a result of the things we're talking about in my classes. So we'll talk about that a little bit more here as we get towards the end of tonight's video. I also got a question from Jayesh on Upstart, which has been quite an interesting company as a result of an interview on CNBC. Some of you will know what I'm referring to there. I also got a question about, selling CVX or ExxonMobil so that somebody could buy CLX, which is Clorox, which I mentioned before was one of today's biggest winners as a stock that we talked about a week ago here in this presentation that had now gotten down to the blue line on the dividend stair-step chart that I use for my long-term classes. Also got a question on position sizing within a dividend growth investing portfolio and some of the additional considerations you would want to think about if you're thinking about selling puts to get assigned shares for a long-term investor. I also got a question on where to find various watch lists for the various trading rooms on our website. And then I got a question on selecting options, in particular LEAPS options, and how I think about that possibility there. Okay, so feel free to check that recording out and all the timestamps you can see there if you are a premium member. Let's get back on track now with the Thinkorswim platform and do some 12 grid analysis, starting with chart 5A, which is our asset class 12 grid. Now, a reminder that these background colors will be green if we have a bullish intermediate posture using the market forecast on those securities, and the background colors will be pink if we have a bearish intermediate posture according to the market forecast technical indicator. So let's get started. You know what? For the first time in quite some time, I am going to say that today's big story was gold. I don't know the last time I said that to you guys, right? I like to kind of start where, we had some big movement amongst these asset class 12 grids, and more times than not lately, we've kind of starting the conversation out with either the US dollar or with treasury yields. But today I want to start with gold. And fortunately for those folks in my Monday top-down trend trading class, we actually recently bought GLD. So we are very enthusiastic supporters of this big move higher in GLD here, where we were up 1.37% today. And that doesn't sound like a big day perhaps to some of you, but remember, for these commodities, they traditionally need a really big push of money in order to impact price, right? There are billions, if not trillions of dollars sloshing around out there in the commodity markets, and gold is going to be one of your deepest, most liquid markets out there. So that was a very impressive move, and you can see how that looks on the GLD chart. Not only were you up well over 1% on a day when the stock market was down over 2%, but you had a gap up to start that process off there as well. That gap up was important because just yesterday, we basically closed right at the 3-month highs from exactly 3 months ago. So it was nice that we didn't use that as an excuse to sell off, right? We attempted that a couple of days ago right there on the 14th, where the same thing, we were kind of right sitting at those previous highs, but then the next day you had that sell-off, giving you the impression that we weren't quite ready for prime time yet. So then when we set this up yesterday, after the bounce higher off of the previous day's low, again, we were sitting right at that prior resistance area. Today kind of gave you the impression that gold was ready for prime time. We were in breakout mode here today. So great to see that, because remember, for all of these months along the way, gold was effectively just going sideways. Yes, it was moseying a little bit higher as opposed to moseying a little bit lower, but we were basically stuck within a sideways range. That is now changed. That is now different. We now have an uptrend in gold, and we're not quite to the highest levels of several years ago, but certainly within this current marketplace where you're struggling to find positive price action, GLD has to be up there front and center, in terms of, possibilities for you. So we have a strongly bullish posture on GLD. We are trading above a rising 30-day moving average. We had a gap up today, which blasted us up and through the previous resistance zone. Those are all considered quite bullish things. In fact, this is probably the first time in quite some time I can make this statement. Take a look at the intermediate reading on GLD. It's 93. Remember, it only goes to 100. So that goes to show you how close we are to perfection on gold. And that is more than oil. So I don't remember the last time I've said that. Remember, oil has been a leader for a long time. It's been hard for any other asset class to outperform oil. But now all of a sudden it's got some pretty good competition from its fellow commodity, gold. So gold at this moment in time has a higher intermediate reading than oil at 83. So pretty interesting there. It's not that oil struggled or anything like that today. It's just that gold did so much better. It has basically supplanted it up there at the top. So keep your eyes on that. Remember, the gold is oftentimes viewed as a safe haven. That comes with a little bit of risk as well, because I think a lot of people that are pushing into gold right now are doing so because of the fear of something spiraling out of control with Russia and Ukraine. So if that doesn't happen, which we should all hope for world peace, right? It is possible that gold could give back some of this move here. So be aware of that possibility as well. But otherwise, just reading the charts and reading the price action, you've got to be willing to admit that gold looks really strong right here. Now, in terms of other areas that are also bullish beyond gold and oil, we do still have a bullish posture on the 10-year Treasury yield. But yields did fall today. So notice that we are back slightly below a 2% yield on TNX. Remember, you move that decimal point over to the left once. So basically, we ended at 1.97% yield on a 10-year Treasury. So remember, when Treasuries yields sell off, Treasury prices themselves go up, and that's that chart over here with TLT. So that's kind of a defensive maneuvering there as well. Remember, when the stock market is struggling the way that it was today, sometimes that money rotates back into the bond market. And we did see that with TLT rising today. The sad news is it's a little bit too little too late for my trade, where I think we're going to end up taking a loss on that TLT tomorrow. Now remember what I told you on Tuesday, this is a situation where you really need to babysit your trade if you have a similar trade on, because what we did was we sold a bull put spread on TLT where we sold the 139, bought the 137. Right now, if today would have been expiration day, you wouldn't have had to worry about an exercise or an assignment taking place because you would have been below the long strike in that spread, just below 137. But you can see how close we are to that. We're only 21 cents away. So if TLT goes up tomorrow by 21 cents or more, then you really have to babysit your position, and you're likely going to want to shut that trade down, because if you don't, then you're going to be assigned on the short leg of that spread, the 139s, and you would end up having 100 shares of TLT in your account for every one of those contracts that you sold. And so that can be a big, buying power, situation that you would likely want to avoid. I'm not going to say that all of you would want to, but more of you, I think, would likely want to avoid a situation where you're forced to buy hundreds of shares of TLT. So remember, if you have that same trade on, you want to get out of that trade, close it down, even if it means taking a loss tomorrow, if it's trading between 139 and 137, which is entirely possible at this point. So even myself, for those of you that are premium members, keep your eye on our Telegram app tomorrow, because I might very well need to shut that trade down tomorrow as well. If TLT is rolling over first thing in the morning and it continues to the rest of the day, then I might very well just let the thing expire, because it would be max gain, but I wouldn't be on the hook for buying shares of TLT. If it does close between 139 and 137 and I do nothing, then all of a sudden, in my case where I just did one contract, I would have to buy 100 shares of TLT at 139. I don't want that, because I didn't ever mean this to be a long-term investment or anything like that. I meant it to be a trade, and so I don't want to have that risk over the long weekend. Now, some of you might forget about it and it might work out, who knows, maybe the world is at war by the time the market opens again on Tuesday, and treasuries are rolling higher in a big way. Who knows? Maybe TLT is at 140 next week, and maybe you would have gotten lucky by just doing nothing and letting the assignment take place. But I'm not really willing to play that game myself, so I will be likely shutting this trade down tomorrow if TLT does close above 137, or if it looks like it's about to, right? You kind of have to make that decision within the last 15 to 30 minutes of the day. So definitely want to put a reminder out there for those of you that might have a similar trade there. But yes, it is true, TLT was up today as a result of benefiting from the defensive risk-off type of a mindset where folks were mostly trying to get out of the stock market, and that money was rotating into gold, and it was rotating into safe havens within the market like staples and utilities, and it was rotating into the perceived safe haven of U.S. government bonds. So it is what it is. You will notice here that the dollar also benefited from that safe haven status to a degree today. It was up just barely. I would call it more of a flat position there. But as I mentioned to you guys on Tuesday, this chart doesn't look all that appetizing from a US dollar perspective. I don't know which way it's going to break. It could go up, it could go down. Right now, you're just basically trading in a straight line sideways. So we're kind of waiting for a breakout in either direction there. Bitcoin does remain with its bullish posture, but you can see that Bitcoin traded alongside those higher octane growth stocks today. Bitcoin was down 7%. So that's not looking so hot. We're at an important level here for Bitcoin, because it's basically sitting right at its 30-day moving average. If it can somehow manage to hold on to these levels, then there's the possibility that you have an inverted head and shoulders pattern that could be carved out here. On the other hand, if it rolls over and starts crossing back below that falling 30-day moving average again, then all bets are off. Then you might very well look at this and say, yep, it was a continued downtrend there. So I would say that Bitcoin is at an important point right here. Despite us still having the strongly bullish posture, we do have a red moving average with price slightly below it. One of those two things has to give. Either we start finding a bottom right here and holding the line, and that background color was correct, or if this is a continued sell-off beyond what's happened today, then the background color is not correct and it's the moving average that's correct. So one of those two things will be proven correct, and you'll likely find that out within the next week or so. So we'll all find that out here together. In terms of some of the foreign stock markets, you can see that once again EEM outperformed. Now remember, you would not expect that on a day like today, so it's worth pointing out. Usually on the big sell-off days, EEM underperforms EFA. But, going back to what I mentioned to you guys on Tuesday, some of those Chinese internet companies held in there reasonably well today compared to how they were getting smashed in the teeth, 6 months ago. There you gave any sort of an excuse and they were down 5 to 10%. Today, they actually hung in there better than a lot of U.S. growth companies. So, don't fall asleep on those Chinese internet companies. I'm not here to say that they're going to light the world on fire, but they are starting to outperform on a relative basis. And remember, they were underperforming the U.S. markets for many, many months. So it's possible they've already taken their lumps compared to what we've seen here in the United States. And therefore, if you're looking for leadership groups, it's possible they will lead us out of this before the U.S. does. I know that's probably strange to hear, but that's kind of what we're seeing in the charts right now. So EEM was only down 1.16% on a day when EFA was down 1.6%, so quite a bit more, and then the U.S. was down even worse, down over 2%. Notice that the U.S. and foreign developed countries like Europe and Australia, Japan, and the like, they both have strongly bearish postures, trading below their falling 30-day moving averages. Notice the difference with EEM. It does have a bearish posture, but it's only a weekly bearish posture, but importantly, it's still trading above its rising 30-day moving average. That is very peculiar and worth sitting up and paying attention to. Let's go ahead and take a look here at our sectors 12 grid as well. This is chart 5C. And as we're looking at this, not a whole lot of places to hide out here either. Again, one of our workhorses continues to be energy. That's the only chart on the board that has the strongly bullish posture. That's that dark green color that you see there. It's the only one that is trading above its rising 30-day moving average. Heck, it's the only one trading above any moving average, right? All of the other charts are trading below their moving averages at this moment in time. Now, since I was last with you on Tuesday, there has been kind of a switcheroo between financials and staples. When I was with you on Tuesday, remember, financials were looking reasonably good because they were still above their moving average, whereas staples were not. 2 days later, we've seen that role reversal take place where the staples have come firing back. Now, they're not above their moving average yet, but they do have the weekly bullish posture there. So things like Clorox that everybody was just puking up a couple of weeks ago are stabilizing right now. And at the same time, you're seeing like the big financials, Citigroup and Bank of America, JP Morgan, and those types of companies really struggling here today and really selling off. So, that's part of that interest rate sensitivity that I'd mentioned before. Remember, interest rates fell today. All else being equal, that's bad for financials and good for utilities. Notice that utilities were actually up today. Don't want to make too much of it because they were just barely up, but they were up on a day when the typical stock in the market was down over 2%. Utilities were up 0.06%. You also found staples acting as a safe haven status there, up 0.77%. So those were the only two sectors up today. REITs are also interest rate sensitive. They did outperform. They were down less than 1% on a day when the market was down over 2%, but they were still down nonetheless. So, it was a tough day, but I think interest rates did play a role today. Financials did worse than the market. They were down 2.5% when the market itself was down 2%. Utilities and real estate both outperformed the market. In the case of utilities, we had absolute gains. In the case of real estate, we just outperformed on a relative basis by being down a lot less than the market at large. So that tells me that interest rates did play a role in today's stock market trading as well. And of course, the staples benefiting today from having, some positive news from, Walmart and Coca-Cola raising their dividends, but also just because this is a market that is trying to hunker down in what it perceives to be blue chip safety. and that's where you're going to find that in droves there in the Staples space. So Staples happens to be my largest personal allocation, but it's not because I'm predicting the markets. That's because that's the way that it always is. And in years like 2020, when tech stocks are all the rage, my consumer staples are not the most fun place to be hanging out. But right now, I personally am thankful to have such a large allocation to staples, because this is where they start to shine. This is where market participants start to hunker down in those areas when they become concerned about growth opportunities elsewhere. So, if you're like me and you're a big holder of consumer staples, this is our moment. This is our moment of outperformance that we're seeing right here, right now. All right, let's get into our trade application example for the day. And going back to something that I had mentioned previously, I hope you guys have kind of noticed my way of going about things. I've been very upfront with you that I've said this is a market that I feel is more of a sell the rips type of a market, not a buy the dips type of a market. And therefore, when given that opportunity, when the market was up on Tuesday, I did a bearish trade on Microsoft. So get used to that. That's kind of how I'm seeing the markets right now. On the flip side, I don't want to get too aggressively bearish after the horse has already left the barn, so to speak, right? Today was a massacre within the stock market, and while it could continue, right, we have that geopolitical, uncertainty going into the weekend. That could certainly happen. It's just not something that I feel particularly comfortable with. I want to sell stocks and do bearish things before they make a big move like they did today. When the big move like today materializes, these are days when I love selling puts. Tomorrow, we will likely end our 2-year win streak that you guys have been hearing me talk about. And what I'm referencing there is for the last 2 years, we have not lost a single sold put trade in either these market outlook videos that I present to you. Again, I can't speak for David because I don't have access to his paper money account or anything like that. But in mine that I present to you, we have not lost a single sold put trade in the last 2 years in either these market outlook presentations or my Monday afternoon options for long-term investors class, where I also teach selling puts. So it's been a heck of a run. I don't think we'll probably ever have a run like that again. It was the first time I've gone 2 years without a loss, and it might very well be the last time, for all I know, because it is very, very rare to go that long of a time to not have any losing positions for a particular strategy. Now, of course, we were boosted by mostly bullish trading conditions in the last couple of years, so without a doubt that had a big role. But I think also careful selection of the securities and the deltas and the reading the Greeks and things like that assisted us along the way as well. So tomorrow that will likely come to an end. While we will have a lot of winning sold put trades that will come off our books tomorrow, it looks like my Monday afternoon class will lose on the VF Corp trade that we did. So while the losing trade didn't come from these market outlook videos that I present to you, so if you're only watching the free videos, our win streak, I suppose, continues. But us combined with what I do in my Monday afternoon class will likely end tomorrow because VF Corp is likely to close well below our strike price. So we will start again. But is it going to deter us? Of course not. I want to continue to do the types of things that has led to that success. And one of the things that I try to do is be brave when everybody else is not. In other words, when the market is roiling like it is today, I find that those are actually better days to be a put seller, not worse, because volatility has gone up and has made those premiums juicier than they probably deserve to be, and all else being equal, that is a benefit to you as a put seller. So what I tend to do in the rules that I teach for the class is I try to find high quality merchandise that's getting punished, and I'm looking out in the 20 to 60 day window which means that the April contracts are now available to us as put sellers, and I'm looking to sell whatever allows for a 1% return on risk. In today's case, it's a little bit more than that, but that generally gives you the idea that I'm selling well out of the money strikes, and that, helps us be more successful from an odds perspective as well when we have choppier markets like we have right now. So the stock that I chose to do today is maybe a little bit different than what you guys are used to. Remember, Corning is one of our sold puts that's going to be rolling off of our books here tomorrow. Another example would be the Clorox trade I did with you guys a week ago on a sold put basis. Both of those, of course, are dividend stocks. Usually, when I'm looking at this chart 2A, we are looking at dividend stocks to help us along with those sold put conversations. Today is going to be a little bit different. And again, it was spurred from one of the questions I got asked from Mary earlier in today's session about secular growth stocks and whether there's going to be some opportunities emerging here in the near term. And one of the examples I offered to her of a stock that I was keeping my eye on is PayPal. This stock has absolutely been demolished. And you can see here that you now have these little green dots that are appearing on the chart after having none of those green dots up until more recently. Now, PayPal was just spun off from eBay back here in 2015, so we don't have as long of a history to look at stuff like that, like I was showing you guys with Clorox, but nonetheless, it goes to show you how badly this stock has been absolutely annihilated here lately. It topped out at $310 just back here in July of last year. Less than 1 year later, that $300 stock is a $105 stock today. Now, there's a lot of charts that look like this, but many of the charts are from companies that are not profitable. And again, going back to the secular growth conversation, PayPal has been basically profitable ever since it was spun off. All of these are positive earnings announcements here in terms of actual profits, not any losses reported along the way. So this could very well be a situation where a baby has been thrown out with the bathwater. And when we get those oversold cluster signals on a weekly candle chart, it captures my attention, particularly since we're now back down here to this possible support area of where we were trading just before the coronavirus meltdown. So what I did was I sold the April $75 put, and we got filled, I believe, at 87 cents. So that is more than a 1% return on our risk there. And what I'm basically doing is I'm receiving $87 up front for every contract that I sell for my willingness to buy this stock at 75. So if you don't want to buy PayPal at 75, don't do this trade. But for me, I think it's an acceptable trade-off. At $75 per share, you are trading below the lows of the coronavirus era, when, of course, more and more commerce has moved online and PayPal has taken advantage of that, mega trend that's in place. Of course, it dabbles a little bit in cryptocurrencies with Bitcoin and things like that as well. But in general, I think this is a pretty high quality company that's been absolutely decimated, and we've got to be kind of in that level of interest for longer term secular growth oriented investors. So that is the bet that I'm making here, is that PayPal will not go down below 75 by the April expiration period. And if it does, I think it's probably a pretty attractive valuation at those levels. So that's what I did for you here today. Hopefully you enjoyed the presentation. Again, if you like these longer form presentations, I ask one simple thing out of you to continue them, which is take 5 seconds out of your day and trade it for the 3 hours that goes into us preparing these videos for you. And if you think that's an acceptable trade-off for yourself, taking that 5 seconds to do that for us, then you're going to go a long ways for helping us continue these long form videos. For those of you that don't like these long form videos and you prefer just a quick hitter 15-minute video, then simply don't do anything. Don't support us. Don't click like for us on Twitter. And if we're under 100 likes by the time I come back with you on Tuesday, then I'll just give you a 15-minute video where I don't do a trade application example and explain all this stuff like I did right now here for you with PayPal. So I'll let you guys decide collectively if you want the long form video. If so, click like on Twitter. If you don't like those long form videos and you want a shorter video, then don't click like. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.